Hi, it's Brendan here from OneServe, and we're going to have a look at risk versus growth and how to outperform the best investments available in the market with your Money Masters business. Now, we had a bit of a problem with the webinar recording on Thursday night, so I'm just preparing this video to walk you through the presentation that we had for the webinar on Thursday, the 21st of July, last week. So, what is the Money Masters opportunity? We kind of have to start at the beginning here to lay out what the Money Masters opportunity is before we can really understand how to lower the risk and therefore increase the growth for this opportunity. So, to understand how it really works, effectively, the Money Masters business opportunity is lots of people borrowing lots of money. It's the short-term consumer loans market in South Africa. One of the group of companies, SA Multi-Loan, which falls under OneSys, which is the group company holder and is a partner to OneServe, and has over 100 branches spread out across South Africa, and they operate in this industry which is estimated to be in around the 43 billion rand per year range, and it's growing at an incredible 20 to 25% per year. So it's a massive market, and it's only getting bigger in South Africa. And what's so fantastic about it is everybody gets up in arms about the National Credit Act, but the National Credit Regulator regulates this entire industry, and it's very, very well controlled, and it's actually a good thing because it forces credit providers to be responsible and to keep quality records and to make sure that the people that are borrowing the money can actually afford to borrow the money. So it's a very well regulated industry. So OneSys is the group of companies, and within it OneServe and SA Multi-Loan were put together. And OneServe came up with this concept where the Money Masters opportunity is exactly this. It's a business that supplies capital to the 43 billion rand industry and earn extremely good interest on that capital in the short-term consumer loans industry. So it is an incredible opportunity to be set up as a credit provider to this particular market. So it's been made available to 150 individuals who each have R1 million or more. So the R1 million is really just the base bottom figure to enter into this particular market. You can come in with more money if you want to. And then we set up their own registered consumer loans business, and it's registered with the National Credit Regulator. It's a PTY limited company that is licensed as a credit provider to this market, and the setup cost for that is about 50,000 rand. But that setup covers everything. It's the iPad to run the business from, it's the software, it's the training from OneServe on how to pay out on the loans and how to run the Money Masters business effectively. It's the partnership between OneServe and Money Masters, so that you can actually have someone finding and vetting loans for you. So it really is the entire setup is for 50,000 rand, and the R1 million is your own capital that goes into a trading PTY limited account, which is in your name, so you're always in control. So the responsibilities are the Money Master has to supply the capital to the market and then pay out daily on the loans that are then acquired for the Money Master. OneServe's responsibilities are to source those loans through their sister company SA Multi-Loan, then vet the applicants, collect on the loans, guarantee the returns of 19% per year, and pretty much ensure that the Money Masters business is successful. Now that we know what the Money Masters opportunity is, we're going to see how we can lower the risk and in turn increase the growth of that capital that you're applying to a particular market. Got to add a little bit extra here, make it a bit more difficult. The key here is without earning more than the insured 19% ROI. So we're going to see how we can leverage that 19% to get more by risking less. Now, what is risk? Warren Buffett defines risk as the potential to lose capital, and that's really pretty much what it is. What we need to keep in mind here, though, with this Money Masters opportunity is that there really is no real risk, purely because OneServe ensures your return on your investment, your 19%, but they also guarantee your capital through a debt buyback system. So, for example, if one of the loan applicants have not paid their debt for 3 repayment periods, you would still have been getting your 90% on that. And then all that happens in the back end, OneServe buys back the capital from you through their buyback system, and then immediately you've got your capital back and you're still getting your 19% return, which is very, very impressive. So you never even are aware that anything's gone wrong in the back end because OneServe is managing it correctly from the back end. But for our illustrative purposes today, we're going to use this particular definition because as entrepreneurs, that is essentially what we're doing. We're applying money to a particular market and we want to know what our potential is to lose that money. And we want to be able to control that potential to lose capital. And in so doing, if we can control it down, we can then increase the growth of the money invested. Now, a lot of people say, the higher the risk, the higher the reward. It is a fallacy, it is wrong. And today, our goal is to actually prove that. And I want you to just keep in mind here, we're going to throw in the legal stuff quickly. There's all these figures used in this presentation are for illustrative purposes only. They really are. We use the gross figures in order to work out the particular numbers, purely because every Money Masters opportunity or business will be different. So different individuals will have different tax liabilities, they'll have different structures, they'll have different amounts of money in it. So every Money Masters business will be slightly different. So for our illustrative purposes here, we're just going to use the gross figures in order to prove a point. Now, just out of interest's sake, this is the graph for the growth in the gold price over the last 10 years. So we can have a look here on the left. It's from about July 2001 to July 2011. Now, as it happens here, you can see that it's been, it looks fantastic. If you'd invested in 2001, you'd be, in the money, so to speak. And what this works out to is that gold has been growing consistently at an average of about 14% per year over the last 10 years. And this graph was drawn down about a week ago, and the gold price was $1,548 an ounce. And I think on Thursday or Friday last week, it was on $1,598 an ounce. But now, remember that the gold price is measured against the US dollar. Effectively, what it's telling you is the decrease in value of the US dollar against gold, and not the actual value of gold going up. It's the value of the US dollar going down. So bear that in mind if you're ever interested in getting involved in investing in gold. But let's get back to the point here. Now, the gold price has grown by an average of about 14% per year over the last 10 years. And if you had invested your R1 million in gold in 2001, you'd have about R4 million in capital in value in 2011. Now, did you know that Barclays Capital, their top performing investment over the last 10 years was gold? It outperformed properties and unit trusts and equities and bonds. It outperformed everything, even fine wine and fine art and classic cars. It really was their best performing investment over the last 10 years. Now, what's nice to see here is they use this really impressive big figure here, that's 323% growth. Now, that when you work that out backwards, it's actually just a nominal growth of about 14% per year. So it's really not that impressive. But to use their measurements to show you the difference between lowering your risk and increasing your growth, we're going to use that gross figure over the 10-year period in order to illustrate our point. Now, these returns are calculated after inflation and include income according to Barclays Capital. Now, what if you had invested your R1 million at 19% return on investment over the last 10 years? Where would you be? Effectively, you're still risking the same amount of money, your R1 million, and your growth would be up to R6.5 million if you'd rolled all of the capital back in and grown that at 19% compounded, which would give you R2.5 million more than if you'd invested it in gold, which is a very, very impressive figure, because that's more than 50% more than the R4 million that you would have had if you'd invested in gold. And that's the top performing investment. It doesn't sound too good to me anymore. So what if we could reduce the risk even further? What would happen to the growth? Well, let's have a look. So the standard calculation goes like this. R1 million capital at 19% return per year, paid out monthly. This is the key here, it's paid out monthly, so you can actually compound your growth on a monthly basis. But for our purposes here, we're just going to use the basic figures. That'll give you 190,000 Rand per year, which equates to about 15,800 Rand per month, which you reinvest in order to grow the capital at the fastest rate possible for this particular scenario. So your R1 million is what you supplied in cash out of your own back pocket, so it's your own money. You would have had a growth of 550% on your capital after 10 years. That's an incredible figure. It's 200% more than Barclays' best performing investment. Now, what if you had a property with 500,000 equity available? and 500,000 Rand in cash. What would happen then? Now, what you have to keep in mind here is the 500,000 Rand cash is what you're physically taking out of your back pocket in order to fund a particular capital investment. If you borrow the other 500,000 against the property's equity, essentially it's only a signature that it's costing you to get that 500,000 Rand. So your risk here is only 500,000 Rand because that's what's coming out of your back pocket. So if you apply those two, what would the results be? Let's just assume the interest on the borrowed money is at about 10% per year. Now the growth on the 500,000 Rand cash at 19% per year would be 3.3 million Rand. And the growth on the 500,000 equity at 9%, so that's the difference between paying the bond and the money earned off of that money, would be about 1.2 million Rand, which gives you a total capital value of 4.5 million Rand after 10 years. Now, this is an incredible figure because what you can see here is that you've effectively risked less than half the amount of capital, exactly half the amount of capital required, but you've achieved 4.5 million Rand in growth over the 10-year period. So what was the actual growth? That equates to 800%. So to calculate that out, you received 4.5 million Rand. You take the 500,000 Rand off that 4.5 million Rand as your initial startup capital, and then your 4 million Rand is the growth that you've had on the 500,000, and that works out to 800% over the 10 years, or 27.5% per year compounded interest. So it's an incredible thing. If you have a look at the different scenarios, with gold you'd have a growth of 323%. In scenario 1, you would have risked 1 million Rand of your own money in order to achieve 550% growth, which is already much better than gold. But in scenario 2, you've risked half the amount of capital, 500,000 Rand, and you've achieved 800% growth on it. So what you can see here is that if you manage your risk down, you automatically will be managing your growth up at exactly the same time. So it's an incredible mind shift from that mindset where the higher the risk, the higher the reward. It's no longer an effective thing. It's just a cliche that keeps people poor, pretty much. So I really hope you enjoyed the presentation. If you'd like to get hold of us and find out more about this, you can email through to marketing@oneserve.co.za. If you have any questions or anything about the Money Masters opportunity, please send them through to questions@oneservemoneymasters.co.za, or just give us a call if you want to meet with us in person. It's 086 111 2753. Thank you for taking the time to watch. Bye-bye.